Are you checking your portfolio every single day? Stop. In this video, I'm going to give you a simple framework that will help you ignore the daily noise and focus only on what actually matters, making smart buy or sell decisions. No more anxiety, just clarity. Most investors react emotionally to every market swing, but the truth is, the most successful investors do almost nothing most of the time. I'll show you why this inaction is a powerful strategy, using Meta as a perfect example right now. Let's be honest, the market is designed to create noise. Red numbers, green numbers, breaking news, expert opinions. It's a constant flood of information designed to make you feel like you have to do something, but you don't. Your default setting as a long-term investor should be to do nothing, just ignore the market. The only times you should pay close attention are when you see a clear opportunity to either buy or sell. That's it. Everything else is just a distraction that can lead to bad decisions. Think of it this way. You don't check the foundation of your house every day, do you? You trust it's solid. You only check it if there's an earthquake. In investing, daily price swings are not earthquakes. They are just the weather. Market volatility is simply the measure of how much a stock's price moves up or down. High volatility means big swings, which can feel scary, but aren't necessarily bad. If this mindset shift is already helping, do me a quick favor and hit the subscribe button. It's free, and you won't miss these simple strategies that can protect your capital. Now, let's make this practical with a real-world example, Meta. The stock has seen some drops recently. The immediate reaction for many is panic. Should I sell? Is the company in trouble? But that's the wrong way to think about it. Here's the right question to ask yourself. Do I still believe in the long-term potential of this company for the next 5 to 10 years? If you did your homework and bought Meta at a higher price because you believe in their vision, their moat, and their ability to generate cash, what has fundamentally changed now that the price is lower? In most cases, nothing has changed, except the price tag. This is a critical concept. If you were happy to buy a new TV for $1,000 last week, you'd be thrilled to buy it for $800 this week. The TV is the same. The same logic applies to great companies. If you liked Meta at a higher price, you should love it at a lower price. A price drop in a company you have high conviction in is not a crisis. It's a sale. It's an opportunity to buy more of a great asset at a discount. This is where long-term conviction becomes your superpower. It allows you to see past the short-term market fear and focus on the underlying value of the business. But this doesn't mean you should blindly buy every dip. Conviction must be based on solid fundamentals. And later, I'll tell you the one critical question you must ask yourself before buying more of a falling stock. So, when do you actually take action? You act when the market presents a clear opportunity that aligns with your strategy. Case 1, a buying opportunity. The company you love, like our Meta example, drops 10%, 15%, or 20% due to general market fear or a short-term issue that doesn't affect its long-term story. This is a signal. It's the market putting your favorite asset on sale. If you have cash available and your conviction remains, this is your time to act and buy more. Case 2, a selling opportunity. The company's stock has skyrocketed and is now trading at a price far above what you believe its intrinsic value is. Or perhaps the fundamental reasons you invested have changed for the worse. This is also a signal to consider selling and taking profits. If neither of these scenarios is happening, you do nothing. You hold. You let your thesis play out. You ignore the noise. Now, for that critical question I mentioned. Before you buy more of a stock that has fallen, you must ask yourself, has the fundamental reason I invested in this company negatively changed? If the answer is no, the price drop is likely an opportunity. If the answer is yes, maybe a competitor has truly disrupted them or their management has made a terrible decision, then you should reconsider your entire position and maybe even sell. Let's recap the strategy. It's simple, but not easy. First, your default mode is to ignore the market. Don't let the daily noise dictate your actions. Second, focus only on clear, actionable opportunities. Is there a compelling reason to buy or a compelling reason to sell? If not, stand pat. Third, let your long-term conviction be your guide. Price drops for great companies are opportunities, not threats. By following this framework, you'll stop being a reactive investor and become a strategic one. You'll trade anxiety for confidence and make better decisions for your financial future. If you want more straightforward analysis like this, make sure you're subscribed to the channel. Now, I want to hear from you. What's your strategy when a stock you own starts to fall? Let me know in the comments below.